What's going on, my fellow wealth creators? Matty Guys here. In this video, we are going to talk about high cash value, dividend paying whole life insurance, but you're not going to hear it from me. You are going to hear it from one of my mentors. He might be a mentor of yours as well. He has a massive YouTube channel. His name is Mark Moss. All right. And if you're not subscribed to him, I highly recommend that you do it because his channel is by far one of the best, in my opinion, when it comes to financial education. I've learned so much from him, and I have watched probably 100, maybe 200 of his videos, and I have never heard him talk about cash value life insurance before. In this video, he does, and he actually uses cash value life insurance as his foundational asset that allows him to put his money to work in multiple places at once. In this video that we're going to break down, he talks about giving your dollars multiple jobs and how starting with life insurance as the foundational asset it sets you up in order to do what the wealthy do. And one of the reasons I wanted to break this down is because obviously, and there's no shame in this. Everybody's in a different stage in their wealth building journey. So I'm not ashamed of this, but obviously he's much further ahead than I am. He's far more successful than I am, which is also, I think, an important thing to talk about or just touch on briefly is that you don't need to be super wealthy in order to take advantage of something like cash value life insurance and get the benefits from it. I don't make nearly as much money as Mark Moss does, but I'm still implementing the exact same strategy that he is talking about in this video. So you don't have to make millions and millions of dollars in order to start doing this. In fact, I would argue that setting up this foundation will help you accelerate the wealth building process and allow you to become much more successful that much faster. Here's why, is because it allows us to give our dollars multiple jobs. We're able to make money in multiple places at once, right? So we're using leverage, we're using good debt. All these are all things that he talks about in this video. But I wanted to share this so that you can hear it from somebody that is very, very successful and uses high cash value, dividend paying whole life insurance as a foundational asset to accelerate the wealth building process in his life. And I talk a lot about infinite banking and all that stuff on this channel. He doesn't talk about infinite banking, but the process is essentially the same, where we're using a whole life insurance policy because of all the benefits. We're not keeping money in the bank. He brings that up as well. The wealthy don't store a lot of money in the bank. They store it in things like cash value life insurance because of all the benefits that we get, the uninterrupted tax-free compound growth. It gives us liquidity so we can acquire income producing assets, et cetera, right? So in this video, I want to break down the video that I watched on Mark Moss's channel the other day. I think it's going to be really, really valuable for you to hear it from him. And then we'll go from there. So I'm going to share my screen and we'll get into it. Enjoy. All right, guys, here we go. So in the interest of time, I'm not going to break down the entire video. I want to keep this on topic with regards to cash value life insurance. So I have some timestamps over here of some like parts of the video that I want to cover. With that said, I would recommend that you watch the entire video at some points because there's some really, really good stuff in it. I will link it down below. But the first part that we're going to cover is him talking about what we're normally taught with regards to building wealth versus what the wealthy actually do and how it's the complete opposite of what we're taught. And then he's going to cover 3 money mindsets that I think are really important to cover before we get into the cash value life insurance part of it, because in order to utilize something like cash value life insurance and build wealth in multiple places at once, it requires a shift in thinking about how we utilize these tools. Some tools including leverage, debt, credit, right? Things that we're normally taught to avoid, which some people probably should, but probably not you. They're tools that can really help us accelerate the wealth building process if we use them correctly. How do we use them correctly? Well, first we have to shift our thinking about them, because what are we normally taught about debt, leverage, credit, et cetera? It's to avoid it. But on the flip side of it, you have the wealthy that are using it all the time. And it's one of the reasons that they're so wealthy is because they know how to use it, right? So the shift in thinking is really important. And then we're going to get into the actual cash value life insurance aspect of it, how it works, why it's so powerful, how we utilize it to invest in real estate, things like Bitcoin as well, all that good stuff, right? So with that said, let's go ahead and get started and have some fun.
Okay, most people follow the same broken formula for money because we've all been taught the same wrong things. Go to school, get a good job, save for retirement, for 40 years, and then hope that there's enough money to retire one day. Well, unfortunately, we can see that this doesn't work, because today, half of the baby boomers that are facing retirement have no savings. And of those that do, the average balance is just about $100,000.
Yeah, this is crazy. I want to talk about this really quick. And yeah, we're taught to play this game of hope. when it comes to building wealth instead of learning how to actively build wealth in our lives, right? It's part of what I talk about in my Millennial Wealth Creator Blueprint. I'll get to that in a second. But with regards to the average 401k balance, like I've looked this up many times, guys. It's really sad. When you look at the actual data, it's pretty dismal. I mean, the average 401k balance, I've seen it a little bit higher, but he might be talking about a different age bracket. But the average 401k balance that I've seen at 65 years old, according to Vanguard, Fidelity, et cetera, is around $250,000 to $270,000, which is still not even close to being enough money to last 20, 30 years in retirement. Like that's just crazy. And but here's the thing: when you look at the actual data, and when you look at people that reach that coveted $1 million mark in their 401k, it's not because of the 401k itself or the stock market did really good. Even though we've been in a bull market for a while, that obviously helps. That makes a big difference. However, the reason that they reached that $1 million mark is because of their contributions. They were able to consistently and regularly put close to or at the max that they could into their 401k. That's why they reached the $1 million mark. It wasn't the 401k itself. It was their contributions. They were able to contribute enough to it. Why were they able to contribute enough to it? It's because of their income. They're making a lot more money versus somebody that's only putting $200, $300, $400 a month into a 401k. Well, you could argue that that is better than nothing. But what you have to ask yourself, is that really going to move the needle in your life? Is that really going to make a significant difference in the wealth building process in your life, right? Is that going to build a lot of wealth for us? Probably not. You don't have enough money at work. Even if the market does really good, it's not enough money going into that vehicle in order to make a difference. And here's why this is just like, it's so backwards what we're taught. We're taught to put the cart before the horse. We're taught to become investors first before maxing out our income and cash flow. That's step one of my Millennial Wealth Creator Blueprint, is focusing on income and cash flow first, not investing, right? I say this pretty frequently on my channel. Instead of the $200-$300 a month going into a 401k, I would argue that's better invested back into yourself to learn how to double your income so that you could put $2,000 a month into your 401k. Because if you do that, now we're starting to make a pretty significant difference here. But we're not taught to do that. We're not taught to like how to monetize our skill sets and our expertise. Like, you go to your job, there's services, there's skill sets that you bring to the workplace, right? Otherwise that place wouldn't hire you. Well, what if you were able to monetize that skill set, that expertise, that knowledge that you provide at your job? What if you were able to share that with the world in a couple of different ways and learn how to monetize it to make extra income on the side? And now you're able to save money, right? Build your vault. That's step number 2 in the blueprint. And then we can strategically deploy, make investments, right? But if we're not making enough money to put into something like a 401k, it's just not going to move the needle enough. And that's why we're ending up with so many people being broke by the time they retire, is because they put too much faith, they were hoping that they were putting enough away and that the market would do what they need to do. And unfortunately, it didn't work out. And by that time, it's oftentimes too late to really do anything about it, right? So focusing on income and cash flow first versus becoming an investor, right? Just relying on Wall Street to build wealth for us. Well, why don't we learn how to build wealth ourselves? And then we start making strategic investments. So again, it's just a different way of thinking about things. All right, so let's continue.
Now, $100,000 is not going to be enough to retire. The problem, that's not how the 1% build wealth. The traditional model tells you, to work hard, save money, invest in your 401k, invest in your house, which sounds smart, right? That's what Dave Ramsey tells us. But here's the problem. Your money only does one job. You put $1 into the stock market, it's locked up. You buy real estate, the money is tied down until you sell the house. But the rich.
Yeah, and the thing about 401ks and even building wealth in your house, it's locked up. Like you can't access it in order to perform multiple jobs. It's only performing one job. Like when you put money into the 401k, it's locked up. It's in the stock market or a bond fund or a mix of both, whatever. You can't typically access that unless you're going to interrupt the growth. And there's all kinds of restrictions on accessing it. So it's only doing one job. It's just not very efficient, right? So that's an important point as well.
They don't let their.
I think that's it for this clip. He's just talking about giving, putting their money in multiple places at once. Let's skip to the next clip here, where he's going to talk about the 3 different mindsets. All right, and yeah, let's get into it.
There are really just 3 types of people, and only one of them builds lasting wealth. Now, the first group is the poor mindset group, and they see money as something that they need just to survive, right? They work, they get paid, and then every dollar they make just disappears immediately, and that's just to cover their rent, their food, and their basic expenses. And then the way they use credit's differently, because when they don't make enough money, then they rely on credit just to survive. Now, the problem with this is it creates a permanent cycle, because every month they're starting at zero, or worse, they're falling further into debt. Now, this isn't an income problem, it's a money mindset problem.
So I actually think it's both. It's an income, obviously it's an income problem and a money mindset problem. I think when it comes to the money mindset, a lot of the times there's I definitely went through this phase in my life when I screwed my life up really bad. It's this lack of belief that you're able to build wealth in the first place. So you don't even really try. Now, fortunately, I kept trying, and eventually I recovered. I got myself out of it. I am where I am today. Thank God. Because I kept working on how, like, my money mindset. I just kept shifting the way that I think about business and money and things like that. Right. But also, though, here's the thing is I'll say that I didn't have the best mindset when I was working my way out of the financial disaster that I created for myself. I was pretty depressed, and I started to accept that I was just going to be the biggest loser on the planet, and that I would just for life, and then I would just never make it. However, I didn't quit. But here's the thing. Because I didn't quit, even though I didn't have the greatest mindset at the time, as my business started to do well, not great, but like my income did start to increase, that all of a sudden started to shift my belief in myself around money and my ability to make money and build wealth. Right. And then I learned this from Tony Robbins, that progress is the greatest motivator in the world. And when you start to make a little bit of progress, in this case, making a little bit more income than you did before, you're able to pay your bills on time, you're able to start saving a little bit of money. That alone starts to shift your mindset around money and building wealth, because it starts to create this belief in yourself, right? So that's why I would argue that it's both are problems, an income problem and a money mindset problem. Obviously, you need to be working on both. But as you start to increase your income by learning new skill sets or taking the skill sets you already have and learning how to monetize them in different ways, you start to make a little bit more money. That alone, in and of itself, is a really big motivator and often snowballs into a lot of positive things in your life. So yeah, good stuff. Let's continue.
Because even if they suddenly make more money, they'd still be in the same trap, spending every dollar as soon as they get it.
This is true.
The second group,
that's a big part of the money mindset there. That's why you need to be working on both. And he's actually going to get into that a little bit here, where as your income increases, a lot of times people's expenses increase as well, which is not good. You need to avoid that at all costs.
What I call the middle class mindset. And it's different, right? But it's just as dangerous. Now, they don't think about wealth, they think about comfort. And here's why this is dangerous. No matter how much they make, they're still stuck, because every time their income increases, their spending increases with it. This is why 60% of those making $100,000 salary report still living paycheck to paycheck. They look rich, but they have no real wealth.
That's crazy. So, I mean, you make a little bit more, you're broke, but just in a higher tax bracket, right? And it's because, as soon as some people start making more money, they see that as permission to go spend more money, right? And increase their lifestyle. They feel the need to keep up with the Joneses and show off how awesome they are, whatever. And there's nothing wrong with having a couple of luxuries. But here's the thing, guys. Like when I was climbing my way out of the financial disaster that I created for myself, and my business really started to take off, I just saved everything. I saved the majority of the money that I made. My expenses increased a little bit, but not anywhere close to what my income was. And that's why I am where I am today, is because I didn't significantly increase my expenses just because I was making more money, right? Again, that comes back to the money mindset, where he's gonna talk about the wealthy mindset here in a second. But it's so important, as you increase your income, make sure that you are saving as much as you can. It's step number 2 in my Millennial Wealth Creator Blueprint, is building your vault. All right. So step number 1 is building income, like always increasing income and cash flow. And then step number 2 is building that vault so that you have enough money to make much more strategic investments, as opposed to just hoping that your 401k is going to perform over the next 30, 40 years. We can be much more intentional, much more strategic with building wealth in our lives, versus just hoping Wall Street's going to do it for us, right? But you have to have the vault. You have to have savings in order to start to deploy it into these different assets that's going to allow you to build wealth in multiple places at once. Okay, so let's continue.
All right, now the way they use credit is also different as well. So They use credit to increase their lifestyle, buy the bigger houses, buy the bigger cars. All right. Now let me understand.
Which is why a lot of people should avoid credits because of that money mindset. They have the middle class money mindset as opposed to the wealthy mindset, which he's
Let's talk about the third group, right? This is the wealthy mindset. Now, these are the people who actually build wealth instead of just looking like they have it. The biggest difference, they don't work for money. They make their money work for them. How do they do that? Well,
again, I would say it's both. Obviously, I get what he's saying, but obviously they make really good income in their business, whatever it is that they're doing, so that they can put their money to work, so that their money starts working for them, and eventually that money makes more money than they do in their business.
They don't make money to pay for their living expenses. Instead, they make money to pay for assets, and they use the assets to then pay for their life. Right? Yep. So it's a different way to do that. Now, what happens is these assets appreciate over time, and they can be leveraged into more wealth, and allows those investments to pay for their lifestyle. And the way they use credit is completely different as well. They don't use credit because they don't have the money or they can't afford things.
Really quick, and actually I'll back up because that's important too. But just to reiterate, because I think that's so important, the difference in the mindset there is so the middle class mindset, they make more money in order to increase their lifestyle. The wealthy make more money so that they can acquire assets. So then those assets can increase their lifestyle. That extra part right there makes all the difference in the world when it comes to building wealth.
Completely different as well. They don't use credit because they don't have the money or they can't afford things. They use credit because it's cheaper to use somebody else's money than it is their own. Mm-hmm. Now you can see that the way that they use money and the way they think about money and the way they use credit is completely different, which is why they end up in a different place. Now I tell you all this because if you want to build wealth in layers like the 1%, then you have to understand one thing, because we're going to be using debt. We're going to be using leverage to build wealth. And that means that you have to have the right mindset.
Yep.
If you're still thinking about credit the way a poor or middle class mindset does, it's something, to avoid, then you're
something to avoid or to increase your lifestyle, as opposed to using credit in order to accumulate more assets and build more wealth. That is the biggest difference between the middle class mindset and the wealthy mindset. That's huge.
Never going to be able to use money the way the wealthy do. But if you start thinking like an investor, if you start seeing credit as a tool, not a trap, then you'll finally be able to unlock the true power of wealth building. All right.
Yep. Very good. So let's skip ahead. He's going to talk a little bit about his journey and how he lost everything in the 2008 financial crash. Again, watch the entire video. It's a really good story, and there's just really good stuff here. But I'm going to skip to the next part of the video that I want to break down, where he actually starts talking about the cash value life insurance.
Do. But when you learn to control leverage, every dollar you earn can do multiple jobs like the wealthy. And here's how they do it. They don't just invest randomly. Again, they build it in layers by stacking assets strategically so their money moves, it multiplies, and it never sits idle. Now, before I break all this down, understand this. This is not a one-size-fits-all system, all right? You don't need to use every single layer right away. Some of you might already have, one or two of these in place. Others might be starting, completely from scratch. Some of you may not even like the layers I suggested, and you can make your own.
That is a really great point. I'm glad he brought that up because so I'm a huge fan of infinite banking. It's kind of the term for what he's talking about, using cash value life insurance to make investments and stuff like that. But like you said, it's not a one size fits all. Okay, so some of the things that he talks about, some of the things I talk about on my channel, you don't have to do. I have a completely different way of investing in real estate than what he's going to talk about, at least right now at this point in my life. And it comes down to understanding your investor DNA. All right, he calls it something a little bit different. That's just what I learned what it's called, whatever. And it's identifying what you are most comfortable with and what you're going to be best at investing in. And it just comes down to it comes down to your investor DNA. So you do need to figure that out, but it's the overall strategy that I think is the most important aspect here. So, but I do like that he says it's not a one size fits all. You need to customize it because everybody's wealth building process is different. Their journey is different. So, make sure you customize it to yourself.
But the goal here is simple. Make every dollar work multiple times in different ways, right?
That's the point. Put your dollar to work in multiple different places at once.
So these are the layers that I personally use and I recommend. But again, don't use these, use whatever, mix and match them however you want. But this is what I do. Okay, so we start number one with layer number one, which is the foundation, which is liquidity. Now, this is where most people get stuck. They don't have a system for stacking their money, right? That's actually why I built the Wealth Engine Assessment to help you see exactly how many jobs your dollars are doing and where you can optimize. Because if your money is only doing one job, right now, you're already behind. Now, if you want this wealth assessment, you can grab it for free. I'll put a link down in the description down below. Just use it, do a test. It'll show you exactly how to map this out. But let me show you how I do this. Let's start with the base layer. So for me, layer number one is life insurance. So let me just go ahead and lay that out here.
It sounds crazy, right? What on earth does life insurance have to do with building wealth? in multiple different layers. What does it have to do with liquidity? Well, I talk about this a lot on my channel. If you guys want more information about dividend paying cash value life insurance, I'll drop some links down in the description. Make sure you check out my different playlists. But whole life insurance is a phenomenal foundation for our finances. Like, it's just, I don't know that there is a better foundation. And when you do it correctly, which is what he's going to talk about here, then it can be your source of liquidity and allow you to start putting your dollars to work in multiple different places at once, basically earning money multiple times at once.
Now, the first thing the wealthy do differently is they don't keep cash in a bank.
Yes.
Why? Because it does two things your bank never will. First, it compounds tax-free over time. Second, you can borrow against it without stopping the growth. Now, most people don't realize this, but when you put money in a bank, the bank immediately lends it out to make money off of you. Meanwhile, they pay you almost nothing.
Right. So that's so important. It's such a huge part of this particular strategy because like if you think about when you put money in a bank, like when I started to implement this, I moved a large amount of my money out of the banking system. I still have some to cover basic expenses for a couple of months or whatnot. That's it. Otherwise, I don't have any money in the bank. All of my safe money, my opportunity money, my working capital is all in my life insurance policies, guys. I have 2 life insurance policies specifically designed for high cash value. So again, what he was talking about, what he mentioned was having liquidity, right? Because when you design your policies correctly, you can get access to 85 to 90% of your money within the first 30 days to start building wealth, to start stacking wealth in multiple layers here. Right. But we build the foundation first in cash value life insurance because we get so many more benefits than if we kept that money in the bank. Right. It's really important to understand that we're just, like you said, we're getting uninterrupted tax-free compound growth for the life of the policy. They typically net 3 to 5% net tax-free compound growth for the life of the policy. All right. It's really good, safe return, I guess, because there's no market volatility. It has nothing to do with the stock market, any of that. Right. We have the tax advantages. Obviously, we have the death benefit, protect our loved ones, and we have liquidity. Right. We have access to the money within the first 30 days so that we can make investments like we normally would. We can start to build wealth like we normally would if it's going to be real estate or whatever it is that you want to do. Right. But you're getting so many more benefits than just keeping it in the bank. Right. Because the bank doesn't do anything for us. They pay us a minuscule amount of interest. Right. You pay taxes on it. And really, the only thing you're getting out of a bank account is liquidity. Right. You get instant access. But what if you could get that liquidity in a life insurance policy, but you get all these other benefits as well? Right. So, yeah, really, really important point.
But the wealthy, of course, they flip the script and they store their cash in a properly structured life insurance policy where
properly structured. Right. You got to design it right.
Earns interest and they can borrow against it. Now, let me give you an example of how the 1% do this. So let's say that you have this life insurance policy and you put, let's say, $100,000 into this account, okay? That's a high cash value life insurance. And let's say it's compounding at 5% per year. So I'm going to put it in there and they're going to pay me 5% a year. Now, it's compounded at 5% a year and that is tax-free. All right. Now,
really quick, I just want to clarify. He's doing a very, very general example here. So I know he knows this, but it's just a general example. But I do think it's important to clarify. If you were to put $100,000 into a policy, you're not going to have access to all of that, and all of that is not going to be earning the 5% here. It's important to know that because again, you are buying life insurance. So there's a cost to that, but designed properly structured, like you said, designed correctly, you should have access to 85 to 90% of that within the first 30 days. And like I said, these policies typically net 3.5 to 5%, depending on the company, depending on how you design it, obviously too, how much you're putting into it. For me personally, I did a large lump sum up front in the first year with both of my policies. That provides the most amount of liquidity, which is really important for entrepreneurs, if you're trying to build wealth, et cetera, right? So I took the money in my vault that I had saved up and I moved it from the bank into these whole life insurance policies. And I immediately had access to the majority of my money. So I still had liquidity. Okay. But now my money is earning this uninterrupted tax-free compound growth. Mine are doing like 4.5%, give or take. But again, it just depends on the company and how you design it.
Then what can happen is I can take that $100,000 out and I would borrow and I would pay 5% to borrow it. Now,
It depends on interest rates. They can fluctuate. On one of my policies right now, the interest rate is 7%. The other one I think is 5.5%. So it's like a net of 6%. So they do fluctuate, but the principles are still the same. And typically, if your loan rate on your whole life policy is going up, typically your dividends are going up as well, because it follows the 10-year treasury bonds, treasury yields, things like that. So it's the principle here that he's talking about is the same.
You might go, wait a minute, if I borrow, if I'm earning 5%, but then I borrow at 5%, like, isn't that a wash? Well, no, not even close. Because let's say I borrowed this for a car, $100,000 car. So let's say over a 6-year loan, let's say times 6 years or 72 months, let's say. Well, let's do the math and see what actually happens. During this time, what I would pay interest, this 5% on the 100,000 is about $15,955. So let's call it $16,000, right? But during that same time period, this earning 5% compounding on the 100,000 is $34,009. So you can see that's quite a bit difference. As a matter of fact, the difference is, my positive difference here is about $18,000.
Yep. So this is really important, guys. And I actually did an example just like this. This was a real life example that I did on my channel. I'm trying to pull up the video so you guys can see it here. But I ran the numbers on this. This was one of the first things that I did with my whole life insurance policy was purchase a vehicle, because it's like, I don't think there is a better way to buy a vehicle than with your whole life insurance policy for a number of different reasons. I'll post a link in the video down below on why that is. But I purchased my car with cash for $28,000, but I put the cash into my policy first and then borrowed against my policy to then purchase the vehicle, because my money is still continuing to earn that uninterrupted compound interest. And the difference between compound interest and simple interest is huge. So the interest rate doesn't have nearly as much to do with it as people often think. I ran the example where you could pay 8% on the policy loan and only earn 4% in the policy and still come out ahead, because of the law of compounding, because compound interest is so much more powerful. You're earning interest on a higher and higher balance, versus when you're paying something like simple interest, you're paying that interest on a lower and lower balance, right? So even if the interest rates on your loan are higher, because of the difference in compounding and paying down simple interest, or simple interest paying down that balance, you can actually still come out ahead. It's really powerful. I'm not finding the video right now. I wanted to show it to you guys on screen, but not a big deal. I will link it down below if you want the full breakdown on how I did that. Let's go back here. There we go.
That I'm making positive during this time, even though I'm earning 5% and I'm borrowing 5%. And the reason why is because of the law of compounding. So the 100,000 is compounded every year while the loan is getting paid down.
Yep.
And while that sounds cool, that's not even the crazy part yet, right? If you had this extra $18,000 now over the life of the loan, and you put it into an account and it continues to compound at 5%, let's say over 20 years, that turns into some real money. As a matter of fact, that turns into $47,902, almost $50,000, which is more than some people save. As a matter of fact.
Right. And it will do that. Here's why. Because when you take a policy loan, your money is still in the policy, earning that uninterrupted tax-free compound growth. Okay. So that's where the building wealth in multiple layers is really going to come in, because when we borrow against our policy for a wealth building activity, not purchasing a car, which is a depreciating asset, it's still a great way to buy a vehicle. But when we start using our policies to actually build wealth, acquire income producing assets, now we're making money in multiple different places at once. Even though we're paying a little bit of interest on that policy loan, it's absolutely worth it, because our money is compounding in the policy, and we're acquiring assets to help pay down the policy loan, et cetera, or whatever, right? We're just building wealth in multiple layers, multiple places at once. And also when you pay that policy loan back, all of your that cash value is immediately restored, just like a line of credit. So you can use it again. So you can use the same dollars over and over and over again. It's so freaking powerful, guys.
As I said, most baby boomers today don't even have any money saved. And you can do that just by one simple trick of putting the money in first, taking it back out, buying whatever you're going to buy. That alone could get you $50,000.
Yep.
Now, what would you do with this money? Well, you can do all types of things. You could invest it into real estate.
Yep.
You could invest it into Bitcoin. You could invest it into businesses or whatever. We're going to talk about how you can layer that next. Okay.
Right. So I'm going to skip to the real estate part. And while I find that, I'm doing this right now in my life, guys, and it's phenomenal. It works so well. And all it takes is a little shift in mindset, the way you think about money, the way you think about these different assets, and you just start stacking assets. Now, with my investor DNA right now, I'm not acquiring real estate like he's about to talk about here, but I am investing in real estate. So I'm the lender on real estate deals. So what I do is, again, I put my money into my policies first. I borrow money from the policy to lend on a real estate deal. So I might borrow at, like I said, around 6% right now, but then I lend it out at 13% plus 1 point. And now I'm making positive arbitrage. I'm making a spread there, just like banks do when they pay us 1%, 2% in our savings account or whatever, but then they lend it out at 4, 5, 6%, right? They're making that positive arbitrage, that spread, literally doing the same thing as the banks. But I'm making money twice in multiple different places here because my money's still compounding in the policy, but now I'm making money in real estate by being a private lender. Now, again, we could, it depends on not everybody wants to be a private lender. Some people might want to actually buy real estate, rental properties, do fix and flips, whatever it is that you want to do. The point is having access to the money while your money's still going to compound and using that money to build wealth in another area.
Leverage becomes a game changer because this is where the layered stacking begins.
Yes.
So let me give you an example of how the wealthy use leverage in real estate. So let's break it down. Okay. So we first started with $100,000 in layer one, and we put that into our high cash value life insurance policy, right? And we're getting compounded 5%. Then we take that 100,000 back out. We don't let it sit there. We borrow against it, and we use that money now. Let's say the 100,000 as a down payment on $500,000 worth of real estate. So that's 200,000. So we take the 100K that we got from our life insurance, and we put it into an apartment complex or a series of houses or whatever worth about 500K.
Okay. Again, this is just another, he's doing a general example here, but I think these are important things to understand, especially if you're new to cash value life insurance. Is you don't typically want to take out all the money from your life insurance policy once you set them up. I suppose you could. It's not that you can't do that, but you do want to be careful because if you don't pay the policy loan back or you don't cover at least the interest, you could run the risk of lapsing your policy. So you do want to make sure that you have a little bit of wiggle room there. And obviously make sure you know what you're doing with real estate. Obviously, we want to make sure that we're not compounding the loss here, where you have a policy loan and you lost everything in real estate. That's not good. But as long as you know what you're doing, you should be fine. You just typically don't want to take out all the money, all of your cash value. Well, you're not taking it out, you're borrowing against it. My apologies. We clarify, that's important. But you're typically not going to borrow against the entire amount. So just keep that in mind.
Right? That's 20% down. All right. So now we have the money doing two jobs. One job over here in life insurance, the second job over here in real estate. That's pretty good, right? This is the first $100,000. Now, over here in life insurance, layer one, it's still compounding, right? So just during the time of this, let's call it 20 years, during the life of this, that money compounding is going to add 47K right here, just because I left it there in the meantime while I also have the house. Now, think about that. 47K on my 100,000, that's almost a 50% return right there just by having to do the second job. All right. Second, over here, we have this $500,000 property, and the tenants are paying down the real estate loan for me. And it's giving me cash flow. It's giving me equity growth at the same.
It's paying the real estate loan and the policy loan as well, because you always want to pay back your policy loan, restore that cash value, and then rinse and repeat the process. But yeah, when you're acquiring income producing assets like this and you have an outstanding policy loan, those assets can pay back all the debt. Your tenants are basically paying back all the debt. Meanwhile, you have this asset that is appreciating in value. It's continuing to generate cash flow. You can then leverage the real estate to buy more real estate, right? And you just keep stacking in different layers here. And it's really, really powerful stuff.
Same time. Also, the property is going up in time. Now, we don't always plan for appreciation, but of course it's going to appreciate. Let's call it super conservative. Let's say it's going up at 3% a year. Okay. So 3% a year. What happens is now at 500,000, let's say times the 3% over the 20 years means that this property is now worth $903,000. That means that if we take the new value, 900,000 divided by the 500,000 means my equity is now $403,000 on the original 100,000 I put in. That means I've now made a 400% ROI. So over here, my $100,000 is sitting here, and I've earned $47,000 over here. It's about a 50% return. And then I took that 100,000, put it over here in this $500,000 property, growing at 3%, and it's made me a 400% ROI. Not to mention the cash flow that I've made over time. Yep. Not to mention the equity that I've gained over all time. But we are still not done, because not on top of all this, you also get up to $500,000 in tax write-offs, even against W-2 income, if you structure this correctly. So let's say that you're a 35% tax bracket. That's about another $175,000 of tax savings that you get. So let me total all this up for you.
Yeah. So I'll let you guys, that's what I want to wrap up with. Again, like I said, I'll let you guys watch the entire video. But I thought that was a really good foundation for understanding how the wealthy build wealth, and how they stack wealth in multiple layers, how they give their money multiple jobs. They're making money in multiple places. And it's just about shifting your mindset around money and how you utilize these different tools, establishing that foundation for liquidity, obviously getting a lot more benefits than just keeping money in the bank. I always say this: if you're going to save money, why not save it in the most efficient way possible, which is dividend paying, high cash value, whole life insurance. The banks aren't really doing anything for us, guys. They're getting rich off our deposits, not us. All right. So establish a really good foundation. So you have liquidity, you get all these benefits, you get that uninterrupted tax-free compound growth. And now, because we have access to that money, we can start stacking wealth in multiple layers. We can start investing in real estate or Bitcoin. He talks about Bitcoin later on down the road as well. But it just comes down to your investor DNA and what you're comfortable investing in. And again, if you're going to build wealth, why not build it in the most efficient way possible? Just like saving. If you're going to save money, why not build it? Why not save it in the most efficient way possible? So get that foundation in place first, and then you start building wealth from there. So I encourage you guys to check out my free Infinite Banking Masterclass. I go into a lot more detail on this stuff. I'll link that down below. Make sure you check out all the other videos that I have on my channel talking about this stuff: whole life insurance, infinite banking, private money lending, all that stuff, right? But I wanted to just make this video because I heard it, and it was just really good to hear, from a mentor of mine that he does this as well. It's just a powerful process. It's really cool here. So anyways, I hope you guys are crushing it. Hope this was helpful. If you have any questions, drop them in the comment section below, and I'll talk to you in the next one. To your success. Matty Ice is out.